Jeff, great to have you on. Rates aren't rising today, but we have seen a pretty parabolic move this year. Your thoughts?
Yeah, the real issue isn't whether it's rates or it's inflation or the market. The point is when things are happening quickly, moving fast, that's when we should think slow as investors. The real challenge, I mean, there's a book, Thinking Fast and Slow, sort of the foundational book in behavioral science, that we don't want to react too quickly. And I think today is a great example. The market shot up, and if we're investing for the long term, we don't want to act on that FOMO, that regret aversion, moving quickly, because you can't time the market. We need to draw back and think about our long-term goals, why we're investing, what it is that we're trying to achieve. And when news comes out about CPI or about interest rates or the market pops, that tends to get us all a little excited, a little agitated, and that's when we tend to make irrational and quick decisions.
Okay, so just to dig into that a little bit more, I mean, the trick to being a good trader isn't knowing when to get into a market, right? It's knowing when to get out. So in terms of being able to take that emotion out of the equation, how do you do it?
There are a few tips that behavioral science teaches us are the sort of best practices. The first is to ask yourself why. Why are you thinking about this decision? How does it serve your particular goals? Not what the noise is and other people are doing, but what excites you, what concerns you, what are you trying to achieve in regards to your portfolio? Regarding that, it's also what's your timeline? Are you doing this for short-term pursuits? Are you doing it for long-term gain? And we have the World War II veterans here, a great example of the importance of long-term planning. Most investing is more long-term. And the third thing is really to remember to try to control what you can control. A lot of stuff, it's not within what we can influence. So control what you can control. And there's a little trick that I like to suggest. It's called advise yourself. Imagine somebody else came to you with your potential choice and said, hey, Jeff, hey, Morgan, what would you do in this situation? What advice would you give that friend? Because that removes the emotion of ourselves. We give better advice to other people than we give to ourselves. We're kinder to other people than we give to ourselves. So if you're thinking about making a move today or any time, just take a step back. Think slow for 1 second and ask yourself, what would I tell someone else in this situation? And chances are that will help you get to a little bit more rational choice.
Okay. So is there such a thing as rational investors? Is this what we're talking about, training to become one?
There's no perfectly rational investor, but it's a continuum. And if we can tip the scales a little bit away from the pure irrationality and get a little closer to something that takes into consideration our opportunities, the data, our goals, the market, what's really happening, what really serves us, that's going to be better than reacting emotionally and quickly, which even the most sophisticated of us often do.